the keep the algo happy and keep it PG if you can.
PG as in I don't know. I was trying
to say damn it and hell. But there's other words we can't say.
Oh, but so we can say damn it and hell, but I can't say beep 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 or beep.
Yeah, you can say what the freckle.
What the freckle?
Well, no, get more creative. You know, son of a biscuit eater. You know.
Woo.
Mother, father.
What was it? HE double hockey sticks? Like, it's almost worse when you. All right.
True.
All right, it's coming through. Notes have come through here.
Woo-hoo.
Market reaction.
All right, that's a big push right there. Big push.
Yep.
I can.
Half back.
Give it a second here. I can see it crowning. Come on, pull it in.
They're flying. It's a boy.
It's a boy. It's a girl. It's a non-binary interest rate decision. Let's see what happens.
Yeah. There we go. Man, they're threatening a flag here. If we get 2 bars, the second bar goes straight through that LZ, guys.
All right, so they're holding flat, so they didn't raise rates. I'm sorry, they didn't cut rates.
Oh. But I wanted the small caps to actually have an advantage in this market condition. That was a middle finger. I love it. F your puts. Oh, I love that.
Alright, so the bot danced and danced and danced and didn't do much.
Watch this next bar. We're almost at the end of this little 5-second flag. Come on. Come on, little fella. You know where you want to go.
Half back happening right now on that 1 minute candle.
Oh, even on the 5 minute. So you can see right here in this top that we've got.
It's threatening to. But, look where the liquidity is.
Right there.
TPO might even show it.
For those unaware on your platform, TPO is time price opportunity. So it's a histogram that kind of shows it shows high volume nodes.
There we go.
Thinkorswim is called monkey bars.
Watch for the LG right here. Fly!
That was probably the best use of an echo ever. Whoever's got the echo in the background for that.
Oh, that good.
Jeremy, you remember Charlie bit me on that? That's exactly what that sounded like.
Oh, yeah.
Okay.
Fly! I can't get to do it again now.
Danced on M&Q for $400. Okay.
Alright, move. Alright, out of my scalp.
Wait for it. Bix is threatening to get smashed right now, but it's so subtle.
Alright, come on, push. Again, we want to see the conference as well. The conference is going to be the big thing here in 30 mics.
Yeah.
And we really don't care about this stuff right here. What we care about is the Q&A after his initial comments. I will also play the I'll drop the link in the room and I'll play it with captions up here for you guys to go.
We're just going to stay inside this 1 minute large candle until that.
Yeah, good point.
I mean, if you look at the past FOMCs, it's been like that.
To the studio. YouTube, I know I went live, but we didn't have time to set this up. It was kind of on the fly, so I didn't add a chat. Apologize for that. But if you have any questions for us at all, feel free, shoot us a comment in the community side, and we always respond. We even take requests. You want a ticker like that? We got that. Bring it.
Okay.
Come on, J Pow, say something cool.
Not yet, not yet. He's still got a half hour, right?
Yeah. Yeah.
Yeah. He's still got a half hour before he starts chipping teeth, man.
I was leading in the 21 Jump Street thing. Something cool. Throws an attack.
Say something cool. Say something cool.
Move over, man.
Oh, hey, let's take a look here at dollar. Actually, let's look at euro dollar. That'd be the one that's really getting smacked. You all right there? Yeah, your lungs sitting on the floor. You good there, man?
Oh shit! I got an open mic. Sorry.
Hot mic.
Ah.
Good. We didn't hear any of the midget porn you got going on in the background.
I thought that was just the old house with the squeaking.
Oh, that's the damn RoboVac running around here. It kicks off now, whatever, and it runs straight to me.
Nice. Jeez, man.
Alright, watch for the sellers here.
Give him a second.
VWAP grabs.
Jeremy, do I get in trouble with HR if I say grab them by the VWAP? Does that get me in trouble?
No, I think you're good.
Okay, there we go. Good.
If you change it to VJ, that's not good.
Huh.
Yeah, don't go there.
No. All right, push. Watch this low right here. This morning low at 940. Watch that low.
And they snagged that liquidity with the high wave, and then they flushed it. But we're just right back where we started, so it's no big deal. We're on a key pivot here.
Back in the day, I worked for this DJ company. It was called Nards Entertainment.
Wait, was that oh God, who was that guy? He would interview like music stars and everything. It was like Nardwall. Was that the name of it?
Nardella. Yeah.
Yeah, man.
Yeah.
I used to.
I worked for him for 3 years, man. Nards Entertainment.
Dude, man, frickin', I loved seeing people's faces. How you know that? How you know I got a tattoo 22 years ago at this little obscure place? Like, we know people.
All right, there's that liquidity sweep I was kind of pointing out.
Right at the VWAP.
We're right now. We got our half back, so we had our push, we had our liquidity grab, and then we had the high wave that failed, and then we got chased down to support for a sweep, and now we're back to half.
So what he's saying is we're jogging in place is what's happening.
Yep.
So just be careful.
Spinning our wheels, but when liquidity gets swept, what usually happens next? Well, you got to know what's at play here. So a lot of limit orders tend to be stop losses. Some of them tend to be trailing stops, so they'll give you an adjustment as they go. They'll get chased. So at some point, when liquidity balances, price goes the other way and sweeps down through or up through, and then back again, almost unanimously. So when that happens, you get right back to where you started, but there is a scalp opportunity there. The next thing is more important. Are we setting up for a bullish or bearish measured move? Because that liquidity's got to do something. When you have a choppy range, it's just getting swept over and over again.
Look at that indecision. God, that's beautiful. What's that? What's that range?
So when we say things like, put half and whole on your post-it note there, this is a big part of it. When you see liquidity being swept, whether it's on a 1 second chart or a 1 hour chart, it does the same thing. Half back, rinse, repeat. It's very likely. And then when it sweeps liquidity from end to end, that's where the liquidity zones come from. So then you know where liquidity is likely to be later.
Alright, candle 3, move up. They're going to push up and then slap it back. Watch here, as I said. I'm looking for a short opportunity within this region here. They'll push it up and they're looking for the rollback.
They're going to slap the fib level there, which is exactly 1 for 1 from the base primary move to middle.
Push, push.
Curiously, the VIX is getting smacked right now.
Like, are we saying, like, what type of smacked? Like, just a paddling or a Chris Rock?
Somewhere in between. It's about down about $1 day over day, and then right now it just dropped like 42 cents.
Oh damn, that's a. Ooh.
So it's kind of in between. It's not quite Chris Rock, but it's on the border.
Okay. Watch now on euro dollar. If you're trading euro dollar, if you do not have the currency pair, you can go to 6E. Is the futures contract on that? 6E as an echo. There we go. All right, they're grabbing that high. Watch for the pullback in this for a scalp.
Dollar,
3, 2, and there's the pull in. Pull.
I'm out with a runner on.
Good man.
Threatening my runner? Are you threatening me?
Bob Michael, JP Morgan, saying this is a dovish Fed. No duh.
Yeah.
Where's my Nicolas Cage one? You don't say.
I just want to see what Mr. Buffett's going to do next. Before he does.
That's a really interesting thing. Like, I know it's been vaguely mentioned over the years, but the redistribution of that wealth will be very, very, very interesting.
Well, he's sitting on, like, what, almost 85% cash right now? He even pulled off his real estate interests.
Oh, no, he sold it. He sold the real estate shit. He sold that to Compass.
Yeah. Which leads me to believe that he sees kind of what I've been batting at a little bit. And there is a two-edged sword there, and I can go into it a little bit, but this interest rate on home loans is not sustainable. The inflated cost of homes is not sustainable. The new buyers who are entering the market have no choice but to sit and continue renting. For the mean of the bulk of those people, there are very few first-time home buyers in this market, and something's got to give. Meanwhile, all of us with brains who either refied or bought at 2% interest rates when they were crushed, we ain't going anywhere. I'm not selling.
Freaking, I had a guy come to me. He's got a 32M loan, and he's asking me, Arch, do you have any resources out there? I want to see if I can refinance. I go, well, okay. What do you got it at? He goes, well, I got it right before COVID. I got a 32M loan, payback on sales at 6%. I went, there is nobody in this market. That's the same thing. I went, what do you want me to do? Pull a unicorn out of my butt? Like, you got a 6% payback on loan with this, and you're asking me to try and get you a refi at like 4% for that in this market? Good freaking luck on that. Like, yeah. I was like, come on. Like, why are you complaining about? I mean, obviously everybody wants to save a point or two, but I mean, God, people are just People don't get it.
When I left Missoula, and I had owned my home for 10 years, my first home in Missoula there. I sold it for much more than I paid for it, which is great. But I paid off that loan literally months before we sold it. Like, I owed nothing on that house. I took most of that liquidity over here and put it down on the current house I'm in. But I also left some out for working capital. And now I'm damn near at 180% of the equity I put into it in return, equity that's appreciated in the house. So when I first did the borrow on this one, I mean it was kind of high. I was like 5.2%, reasonable for the time in 2019. But then when the rates dropped, I'm like, hell yeah, I'm gonna do a refi. I'm not stupid. So I mean, get back in at 2.72 or 2.8%, something like that. Yeah, no brainer. I didn't even take any cash out. I just rolled the straight loan into the refi. I don't
Roll that
care if
baby
it's
over.
not.
Yep.
So I'm not going to sell this unless I can get 4x liquidity out of it. Meaning, I want about double market value before I'll even think about moving at that rate, because I know what the new rate's going to do to any leverage I pull out of that. Right? I am not in a borrowing market right now, and I don't care. But I put myself in the shoes of a first-time home buyer, and it's like I see the pain they're feeling right now because I felt it back in 2009. Only rates were, I mean, they were a little bit beefy, but for first-time home buyers with lower-cost homes, it was doable because it was recently after the 2008 bubble hit the bottom. Basically, it was in recovery mode at that point. It was a great time to buy. Unless we have another black swan event like that in the real estate market that drives the prices down at this interest rate, hell no one's touching a house.
No, it'd be dumb. That's the same thing.
Yeah.
I had some people asking me about buying the Montana property on there, and I was like, do you realize what this place is going to cost you and at what rate? They're like, yeah, shoot a number. I was like, you really don't want me to do that, because I got it at a hell of a rate years ago before COVID. I don't sell.
And the other thing is, like, I could go, if I wanted to go and invest in real estate, there is an option there. I can go and sell now. Someone will buy it. This neighborhood's pretty popular. Just had a comp down the street sold for quite a bit more than I thought I was appraised for. So it's still in demand. I could go and flip this place, go rent for like a year, wait for this market to just melt completely down, and then go buy 2 more houses or 3 more houses. One for each kid, for all I care.
Man, that's what I got to figure out is the heck I'm going to do for my kid.
It's a thought that's on my plate, and I'm just like, well, I could downsize temporarily a little and be able to do that, and it would be a smart thing to do. But that's not going to come without risk. In the meantime, I'm going to have to be like renting from someone or something.
Well,
so
I mean, it always has risk, obviously, but it's like what's the educated numbers with? See, that's something you guys and gals, for the day traders, you haven't heard much yet, but I always complain about is capital efficiency on there. And that's like, look at multi-market on there. Okay, what is the rate of change of your dollar, and is it outpacing real inflation on there, which is like 18-20%, something like that, and depending on where you live and where you're at. And that's the thing to really keep in mind is like, what's that capital efficiency? Like, oh yeah, I just take it, go put it in a duplex. I go, okay, let's run the full calculator on that. Depreciatory value, expected sale value, add the inflation on top of that, and then add the general maintenance values on top of it. And even for me doing new constructions on there, when I ran the number, before I break even on anything, it'd be 8 to 9 years on that. And I'm sitting there thinking, 8 to 9 years. Like,
here is a two-edged bigger factor that I consider as well. So, in the midst of this, we have a administration looking to eliminate federal income tax. That could boom the market even at these rates and even at these inflated prices. And if, and only if, that revenue is replaced so there is no deficit and suddenly you have deflation, think about what deflation does to debt. So now, at inflated rates, your debt is worth less value. So your things that you own are worth more dollars now. So if deflation actually occurs, suddenly the things you own now are worth less dollars. So you got to really consider that factor. If this thing kicks off, it's going to toss inflation on both sides of the fence for a brief time. That'll wobble. It'll be deflation and inflation, deflation and inflation. It'll cycle, but it'll wobble. And if you time it right, you can greatly benefit from it. Yes. So if you generate a little extra debt now, you could realize that debt value will appreciate in monetary value, unfortunately. So if you had debt now, you're kind of foolish if you're up against potential deflation.
And I'm going to throw a Rosie O'Donnell style wrench in along with that, and that is, what are you valuing your asset in? Are you valuing it in USD, Swiss franc, yen, and or BTC on there? If you value it BTC or ETH on there, because you got different premiums on top of all of that, and it is very, 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 very real thing. I have seen many, many, many transactions, both on the commodity side and on just general sales and purchases for assets being currently settled, not in dollar, not in G7 currencies, but settled in ETH and USDT and BTC on there. And
well, I value my asset at number of farts per minute, and I mean it really. That's my currency. I rate it by number of poots per pace, or how many paces I can get, as I play the song. And 7 is usually a really good trade for me.
Well,
I get 7 paces,
Well, the cost of an A1 Abrams in that calculation would be the Putin pace after a good Zelensky. So, something you got to keep in mind.
There you go. The poo factor.
Ah, the poo factor. The poo factor.
Well, Jay, they say if you try to push a put, it sometimes turns out kind of shitty.
Yeah.
I think we can get away with that word. That's PG enough.
Hey,
sorry.
That's okay.
No, can't take it back now. Yeah. So
That's right.
That's
That's
like-
PG enough.
well, no, that's like the while we're waiting on this to work out, guys. If you're wondering on the chit chat and stuff, we got 7 minutes until the until PAL conversation comes through. I'll bring up the feed here. All right, Jeremy, I got one for you. What is the favorite dictator of most felines?
Oh, dang.
Mao.
Oh, man. That kills me.
I don't know why, but I was sitting in traffic the other day, and that one popped up in my head. That one's an original one for me. I was like, oh man. So what happens when you're stuck in traffic.
No, you come up with some pretty interesting things when you're stuck in traffic.
Ah, man, dude, that's what I miss about being.
Thinking in traffic.
Dude, that when I was on the Harley and I just freaking ride for hours and hours, and yeah, it really did help me a lot with trading too. I'll be honest on that one. You just take time, you hop on the bike, and you just freaking go. You're just like, all right, it's just me to think and put stuff together. You're doing about 80, 90, 100, and you just thinking about trades, lives, everything.
All right, that'll be a nice thumbnail.
Guys, give me a second. I gotta do a plug-in once again. Give me 2 seconds here. I just see it tried to die on me.
hanging out at the edge of that liquidity zone now. We could see a move higher depending on what comes out of the Fed next, I guess. I'm not watching the FOMC thing. I can read the chart and it'll tell me what they're saying. It used to be I could look at a 5-second chart and know how many footsteps J. Powell was away from the podium.
But then Jay changed shoes, and
Right.
everything just changed with that.
Just switch to loafers, damn it. Question is, why is TNA suddenly somewhat bullish here? I would expect the small caps to frown upon, rate stagnation, but I guess.
Well, it didn't go up. That's the thing.
Right. I guess that's a good thing. It didn't go up. So, I mean, small caps can definitely benefit from stability. Yeah, I can agree. I just, every once in a while, I'll get the soundboard out and just screw around with it. Yeah, that's a good point.
Riding Cat, which way do you want it to go? Let's start with that.
Karaoke shots. Hey, there you go. I love doing karaoke. Karaoke's fun. Start singing stuff like, hold the line or something. I don't know if they're plotting with me or at me. Alright, so we're essentially static at this point. We're not really seeing much movement because we're just waiting. It's like waiting for a shoe to drop. I can say that the VIX is still kind of threatening to go lower.
Well then, give me a pop, get me out of all this market chop.
Right?
There's your song. Like that over there, Riding Cat?
If we look at the bar where I posted that 1 minute chart in the chat there, the bar from the pivot to the edge of that liquidity zone, it's exactly a measured move at the top of the zone, is what I'm talking about. So if we get a pop here, a significant move.
Seriously, folks, though, it is a very quiet time until everybody waits for Powell to start speaking, and then every algo hangs on every word that he says. Did he punctuate? Did he have the Oxford comma in the right place and all that kind of stuff? It gets interesting when he starts talking and the markets start reacting to it.
Indeed. It's great to be able to shoot the breeze and just completely go off tangents and mess around while we wait. It not only passes the time and it's entertaining, but it's also something that it gets us into some fairly in-depth conversations sometimes, even if it's about fishing.
Well, I mean, I use debate to catch the fish, so.
There you go.
Yeah. All right, let's see. Volume off. Captions are on. 2 minutes. Guys, give me a second. I gotta reshare my screen on this. Give me 13 and a half seconds here.
Sure.
Ironclad is bored. He's the old man in the room, not having fun. Aww. You gotta have boring times, man, to appreciate the rip and roars, man. You gotta have them. It's like days to appreciate a shiny, sunny day.
I'm a little on the bored side because I gotta jump on work calls for the next 2 hours. So.
Dude, I feel you 100%. 100 freaking percent.
Until I'm able to buy my freedom,
That's what we're working on, aren't we?
Let's see. Alright. Chat is Get this
Alright,
here.
market update. Watch the market go to the moon now. I gotta jump on work. I'll be having y'all in the background.
That sounds good, brother. All right, we got the POW stream up on the top right. We got the euro dollar on the base. We got the NASDAQ on the high. The laptop is plugged in. All right, what color tie? I'm seeing, is that a black? A purple. Okay, we got a purple tie. All right, how many times are we going to hear the word transitory? Dual mandate. That's got to be a given one. Dual mandate. That's got to be a free zone.
This year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their
I got a long gone.
Outlook is high. As we parse the incoming information, we're focused on separating the signal
and pulled that off.
Evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty today is unusually elevated, and of course these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal.
Love those calls.
As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings.
It's a good thing, actually.
We intend to wrap up the review
And
by
we're both
late
recovering.
summer.
Antibiotics are awesome.
The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored.
Yeah.
Our success in delivering on these goals matters to all
Yep.
Americans. We understand
And
that
it's
our
like,
actions
it's
affect
obvious
communities,
stuff. It's like,
families,
well,
and
yeah,
businesses
dude,
across
I'm
the
aware.
country.
I know.
Everything we do is
I
in
wouldn't
service to our
own
public
any
mission.
pets if I
We at the Fed will
was
do
unaware
everything
of
we can
these
to
things.
achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Well, this is an interesting take.
Howard Schneider with Reuters.
Let me get this posted.
Thanks for your time. So, 2 things on sort of the real side here, with inflation and then
I gotta
GDP.
download the damn thing?
How
Okay.
much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you
Let me put
effectively
this
viewing as a
in
one-time price
the
level
chat.
Okay, so
I almost put
how
it
much
in
of
a
it is,
moderator page. Here
is
we go.
tariff. So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods
you can
inflation
decipher that
moved up
one.
pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation.
The fact that they're
In terms of
unwinding
the
mortgage-backed
your sort of,
securities
looking
is
through question.
very interesting on
Too soon to say
the
about
thought
that.
process that
As
I
I've mentioned,
was speaking about earlier.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff
Nice.
inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is
Yep,
unchanged in the
exactly.
out years also, doesn't that imply you all have basically
So,
decided that there is no
here's how this
signal
works
here,
in
and that
a
it's just gonna
deflationary
go back to transitory
environment
again?
where
So I think
mortgage-backed
that's kind of the base
securities
case, but as I said,
depreciate
really
in
can't know
value.
that.
It's sort of like the
We're gonna
Fed
have to
sold
see
them
how
to
things
open.
actually
They buy them to
work out.
close
And
for
the fact
less
that
than they
there
sold them
wasn't
to
much
open
change,
for.
I think that's partly because, you see.
It's the
weaker
Fed
growth,
wheel
higher
trade,
inflation,
y'all.
they kind of offset. And also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment.
That was a
I
pretty
think
good
there's a level of
segue, huh?
inertia where you just say, maybe I'll stay where I am.
So essentially, they're going to be cycling through some of their debt, but
Thank you,
what
Colby
it really
Smith,
means
New
is they're
York
going to be
Times.
building
You
that
just
position.
described inflation
And they're
expectations
going
as
to
well
be
anchored, but has your
taking
confidence
it
in
in
that
what?
assessment changed at all?
Interest.
Given the increase in certain measures and the high degree of uncertainty
That is their
expressed by
premium.
businesses, households, and
No one really
forecasters?
thinks about things that way.
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and,
All right.
short-term,
Well, I'm flat
long-term
on this one now. We're at a
households,
halfback
businesses,
point. I might be able to
forecasters,
scalp one
market-based.
more wave out of
And I
this
think the
bull side,
picture
but
broadly is
this
You
looks
do
like it's
see
not going to quite finish our
increases,
MM just yet.
widely in short-term inflation expectations.
So
And
be
people who
careful
fill
if it
out
can't break
surveys
the previous
and
high,
answer,
if you're gonna try and long something
questionnaires
like this.
Are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York,
Give me
for
half
example,
back,
you have
1990.
market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year
fries are
forward,
done.
you'll see that break-evens are either flat or actually slightly down. In the
Now we're
case of the
right up
longer
against
term
that
ones.
previous
So
high,
we look at that,
1940.
and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer
There's your
confidence
halfback.
surveys?
Now let's see
You
what the
said
next wave
recently that
brings
this
us.
is perhaps not
Money,
the
money.
best indication of future spending.
Gimme,
But I'm
gimme.
curious, what
High
you
wave
think is
printed,
behind
high wave
this
exceeded,
deterioration,
next
and
wave
to what
breaks.
extent
See ya.
it could be a leading indicator for hard data.
So let's start with the hard data.
I love it.
We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy
Looks
level.
like the solicitors are running around
Has
tagging
started to move
mailboxes.
up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture.
Base case is
The
that
survey
inflation
data,
will be transitory.
both households
What?
and businesses show significant rise in uncertainty and
Are you
significant
trying to-
concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out,
Mandatory.
the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy.
What do
and then
these
going
guys
out and
think we
buying a
are
new
by
car.
now? That's what I want to know.
But
What do
we
they
don't know,
really think of
that
us?
That will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will.
It would be neat to
But
get a candid
given
conversation going
where
that
we
gets,
are, we think our
leaked
policy's
somehow.
in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about. what
Come
the
on. How do
economy's
we
doing.
get to a point where they're blatantly saying this stuff out in
Tim Ross, The
public
Wall Street Journal.
anyway to those who
Chair Powell,
interpret
Chair
it?
Greenspan once
like
defined
we do.
price stability as,
We get
an
it.
environment in which
We know
inflation
exactly what
is
they
low
think
and
of us,
stable over
but
time, that it doesn't
what does the
materially
general
enter,
public understand of this?
into
Nothing.
the decisions of households and firms.
It really sucks.
That we have that price stability, that households and businesses are ignoring price growth. When you see buy in advance
Yeah.
psychology, big changes in inventories and
It's,
surveys that show,
consumers, at least in the short run.
I know what they're saying. I know what they're doing.
So
I know how they
I
operate.
like that definition a lot.
And I can see right through their
the
bull.
recent,
And I'm
conference
sure
was.
everybody
So
here
I
can
think
too.
a
Even
world where
beginner
people can
traders
make
kind of
their
get
daily
that.
economic
You
decisions
understand
in
what they're doing.
businesses, and they're not having to think
It's
about
all
the
about
possibility of significantly high
that bottom
inflation,
line, no
inflation
matter
that's
what.
around. That is price stability.
So
You know, I think
when you're
we're
selling
getting
debt
closer
and
and
collecting
closer
premium
to
on
that.
on
I
the
wouldn't say
interest
we were
rate,
at that. Inflation
and
was
you're not
hovering
even
around
the guy
2.5%
who's like
for some
you know,
time.
the one that
I
everybody
do
points a
think with the
finger at
arrival
because
of the tariff inflation,
you know you're charging an exorbitant
further
amount
progress
of
may
rate
be
for
delayed.
revolving
The
debt.
S&P doesn't really show further downward progress on
You get to
inflation
sit
this
back
year,
and just
that's really
you're
due
like
to
the
tariffs
pick
coming
and
in.
shovel salesman. You
So
don't care what they do with
delayed,
it.
But if you look at the
You're lending to banks.
forecasts,
The
we
banks
do
are
see
dealing with
ourselves
this
getting
stuff.
back into the low twos in 26 and then down to 2 by 27. Of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
All right, we're just about to the top of the liquidity
Again,
zones. We're
people
finally
looked at
finishing that
2
move.
Cuts the last time, and they look
Be
at-
very
they look at
cautious when we
the,
tap
you
the
know,
top of that thing. If we don't see a
they
big old
wrote
spike
down,
out of it,
meaningful
we can
decline in
actually
growth,
ooze on up to about
from
484 on
2.1 to
QQQ.
1.7 in 2025.
If it does not
A
break
tick
out
up in
of the top of
unemployment
this
rate,
with
so
a
not
big
much
old,
there,
1
but
minute
core
candle that just
inflation up
stands
by
on it.
0.3. And so those two kind
So
of,
if you see that,
those
that's
things
gonna
kind of balance
definitely
each other
be,
out. So people, not everybody,
a
but on
liquidity
balance,
trap,
people
and it
wrote
will
down
get chased
similar
and
numbers.
sold.
The changes aren't that big.
If we
The
do
other
just
factor,
sort
though,
of
as I mentioned, is
consolidate
just
at the upper
really
edge
high
of this
uncertainty.
LZ and we start
What
to
would you
get
write
a little
down?
momentum
I mean,
slowly,
it's
we can
just-
trend.
It's really hard to know how this is
Algos
going to
are all
work
over
out.
this stuff.
And again, we think our policy's in a good place.
The
We think
more
it's a
they
good place where we
participate in
can
the market
move
and the
in
less
direction
retail
where we need to,
participates in the
but
market,
in the meantime, it's
the
really
easier this chart is to
appropriate
read.
wait for further clarity. And of course, you know, the costs of doing that, given that the economy is still solid, are very low.
just know where they're sweeping.
Edward.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment
This
rate,
pullback at the
that
upper
should be
edge
low
there is
enough to
actually
bring people in
good.
from the sidelines
Let's wait for
in terms of
accumulation. Let's see if we
hiring.
can scalp the
But
next
we're
wave.
seeing the hiring rates
Half
have been
back
stuck
target
at
again,
2023,
19,940.
2024 levels. So what's going on there?
To the downside,
Yeah, so
which we just wicked.
that's a feature.
And then
that
fifth
has been
target,
for some time a feature of this
19,975.
labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting, relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs,
Just
so you're
dip
not
that
seeing
toe in
people
that
losing their
940
jobs,
pool.
but you're seeing that
See if
people
they
who don't
push
have
it
a
or they're
job
dropping.
having to wait longer and longer.
Liquidity's right
And,
there.
the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job
Yeah,
creation.
you're right. It's
too.
always a liquidity
So
sweep.
overall, it's a labor
Every
market
time
that's
they
in
get
balance,
involved.
And, we watch it very carefully.
So then, have we seen the
The
administration?
key for us is to not be their
economic
absolute
numbers
liquidity.
yet? And
We
when
want
do
to be
you
on the
anticipate
right
that
side of the
happening?
trade.
In labor or in other?
In labor and
And
inflation,
realistically,
just
we can
across
just
the
watch a
economy, have we
chart
started to see
and
the new
hang on to their
policies take
coattails.
effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months.
Yes.
For example,
Come on,
the,
nail that
layoffs
fib
that are
target.
happening here
Just under it, I would
are,
say, would be a safe haven exit.
They're certainly meaningful to the people involved. And they may be
7.2,
meaningful to a
7.35,
particular
somewhere around there.
neighborhood or region or area. But at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation
This
readings
next
in the
wave
last 2
should
months, which
just
is
touch that.
very unexpected. And
Come
I
on.
think hard to trace it to specific.
I love
terms, but
volatility.
it
This is
must
my
have-
bag
it must
here.
have something to do with it's either noise and it'll come back, and that's very possible
Go,
too.
go,
But if
go.
it is persistent, then it must be to do with people buying ahead of tariffs or raising
They're
prices.
getting
ahead of
smacked by
tariffs
sell
and things
orders
like
at
that.
70, but they're gonna
Those kinds
push.
of things happen.
Here
and
comes the
it's very,
wick.
very hard to capture because so much of it is indirect. A great example is
dang, they swept
their
it.
washing machines were tariffed in the last round of tariffs.
Target's still the same. They're
and
dipping that
prices
pool
went up,
one more
but
time
prices
is all.
also went up
They're just
on,
taking out stops.
on dryers.
Stops
not
are
charging.
liquidity.
So the manufacturers just, they just kind of followed the crowd and raised it. So
There we go.
things happen
Push.
very
Hit my target.
indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
How's it go? I want to shake with my
Craig
fries.
Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time?
Nope.
And
They
didn't
pushed.
the FOMC forecast lower inflation ahead?
Still the
last
same
time?
target. They're just going to try and tap
wasn't the
940
lesson
again.
that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during
Okay,
the
'cause you
pandemic.
could have been
Current
talking
fib
about
on the last
time
high
there
is
were
actually
tariffs,
only
in
965.
which case the inflation was transitory. Yeah, no, of course, we're well aware of that.
And this is wave 3, so if they don't break out here, there's no love.
It's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering
There we
economic
go. Come on.
activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this
Dan and Mortimer, Marziti.
as a different situation. There are differences and similarities.
I got a few more minutes, and
it's
then
a
I gotta
different
bug
time.
out, too.
We haven't had
I'll
real
take it
price
to 3.
stability fully reestablished yet, and we have to keep that in mind. And we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
So we have two goals, right? We have maximum employment and price stability, and we have to balance those. And there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal, and then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really show significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand
I
on
am flat right
whether or not
there
the
and
slowdown you're seeing
happy
creates
as
a higher
hell.
probability or concern
Right on the
you
edge of
may
that
have
liquidity
of
zone.
Recession. Thank you.
There's always an unconditional possibility of a recession. It might be broadly in the range of 1
thank
in
you.
4 at any time.
That
If you look
LZ
back
was,
through
like,
the
on
years,
point,
There
dude.
could be within
Edge
12
to
months
edge.
a 1 in 4 chance of a recession. So the question is whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside
Watch this next
forecasts,
candle. If it's
forecasters
really
have
stupid
generally
fast,
raised, a number of them
it's
have
likely
raised
gonna
their
sweep.
possibility of a recession somewhat, but still at relatively moderate levels, still in the region of the traditional, because they were extremely low. If you go back,
I still
2
have
months,
some VIX puts
people were
going, so
saying that
I'm pretty
the
happy
likelihood
with
of a
those two.
recession was extremely low. So has moved up, but it's not high.
These are VIX puts I opened last week.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent
Give me half
people.
back to
If those firings stand, is that a threat to
1975
the
one more
Fed's
time, I think.
independence? Could he do the same thing to the Fed board?
Maybe 1970.
I think I did answer that question in this very room some time ago, and I no desire to change that answer and have nothing new for you on that today.
Well, maybe I'll have another mulligan.
Mulligan.
As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing what we saw last week from the University of Michigan, or does that carry the same weight?
I love Family Guy.
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post.
Come on, hit
story.
970.
It wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. We look at it, we don't dismiss data that we don't like. We force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say
this is actually not bad if you look at
all
LZ.
of them, and that was kind of an outlier, but nonetheless we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you reassure people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that, and we will use our tools to foster achievement of our goals to the best we can, and of course we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. These decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Okay, next test, if it breaks down here, 20,000.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months?
is 1 mm up from here, from that base of 2,000 or 20,000 even.
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that you're reading about developments. The news is full of developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be